ask a question on. Don't hesitate, ask. There is no dumb questions. If you have not worked in mortgage coaches much and you're like, hey, Tina, why are you not using this? Or why are you doing it this way? Please, by all means, ask me in there. I want to make sure that you get it. So I'm going to stop sharing my video so we can focus on the screen. We don't need to focus on me. And we're going to start by going into the new client. Once I go into the new client, I'm going to place in my basic information. Since Dave made me a little late today, we're going to use Dave as my client. I'm going to put in that phone number. And for those that don't know, this is going to provide the phone number on the alert. So that is going to be that phone number on the alert. So that's why it's essential. If I did have a referral partner, I'll throw it in. And this is something I do. I do place in my presentation name, purchase, but then I put when I plan on closing them. The reason why I want to do a quick pipeline search to see what am I going to close in December? What am I going to close in November? I can search purchase December 2020, pull up everything in that friendly name, and then have that there so I can go through and I can count. I can also use it to say, where do I need to put my time? Where do I need to leverage it? Remember that next button is your save button. So clicking through that next, this is the only one that shows up on the presentation. I don't have an address to your new home. Again, I'm about strategy. This is strategizing, making my client think this is the next step, not this might or might not be a possibility. So buying your new home is that next step. I'm going to place in the city that they want to buy in, the state, and the zip code. If I don't know this information, that's okay. I'm still going to put your new home because I want to mentally change the mindset of my client to we possibly can or cannot buy a home to this is happening. And I actually forgot we're doing rent versus own. So right here, prepare a rent versus own. Make sure you click yes. This is going to allow it to open up that rent versus own information so you can start putting it in the client's actual information. So we're going to get my first home. Goals are important. If I don't place the proper goal, it's not going to ask the proper questions. So make sure you are placing in the goals. I use 2 goals. I am all about simplicity. Get my first home or other. The other ones are going to open up a current loan scenario as well, but if I'm doing a refi type of refi, I'm going to use that other. Assumptions, here's where we start putting in our rental information. I'm going to use California numbers because I know them so well. Let's say $1,850 is their monthly rent. Their annual rent increase, 3 is pretty standard throughout the country. You can look it up county by county. Mortgage insurance, remember, mortgage insurance, once this they own, this is going to be replaced by that property insurance, their hazard insurance. So make sure you are dropping it in there. Other monthly rental expenses. This is going to be, do they have to rent extra space? Do they have an HOA? Do they have to rent a car space? Appliances, pet fees, anything that will dissipate once they are no longer renting. That is going to be placed in here. And the reason why is because when they're renting, they no longer have that cost. I'm going to say they have $150 for a garage rental that they have to pay as well here. Paying for parking is pretty common in Southern California. Clicking on my next button. This information is all by choice. You can choose to fill it in or you can choose not to. It does not show anything on the TCA. Minimal information I choose to fill in here is my current gross income and their monthly debt. Because if I'm a little unsure on if they qualify for a certain amount or not, I can go and look at the little right side once I start doing my product and watch their debt to income ratio. So again, quick place for me to do just a verification. Expenditure, not going to fill it in. If I wanted somewhere for me to remember things later, I can fill it in, but I'm going to choose not to fill it in because it's not going to be of much value to me. If I already have this somewhere else, if you're using a CRM, if you have somewhere else you keep notes, don't double up the work. place it all in one spot. Product one, here's where we're going to start building our first product. Now, doing a rent versus own, more likely first-time home buyer. First-time home buyer, we're going to be looking at an FHA and possibly a 3 or 5% conventional. So I'm going to start with my FHA loan. If you have product templates, dropping that product template is going to be the fastest way to do it. So I would drop the product template. I'm going to choose not to, just for anyone who has not set it up yet. So I am going to have an upfront premium. That is going to be my FHA. Purchase price, I'm going to say they qualify for $375. I'm going to say the down payment, it's FHA, 3.5%. So I'm just going through the basics here, filling out that information. And last, the term is $360. So if you have your get pricing button, you can definitely use that in this case. That's anyone who has Optimal Blue with an enterprise account. Closing cost, I'm just going to drop in a FHA purchase template, and that one doesn't have much in it. Oh well. So you drop in your template and you'd apply it to your loan. Now you're going to see APR, and this one doesn't have anything marked APR. There we go. So you're going to see your APR, your non-APR cost in here. If you have points or lender credits, you can throw that in. And finally, I'm going to throw in my prepaid days of interest. I like using 15 because normally that's what's on your loan estimate. Last thing I'm going to do is my upfront MI. I'm going to come down here. I'm going to add that 0.85, add it to the loan amount, and click on my next button. Finally, adding my monthly cost. My company uses $80 a month to qualify for the hazard insurance. Southern California, 1.25 is pretty standard here. Mortgage insurance, and I noticed I did the wrong percentage over there, but we'll leave it. Now here's where you do want to make sure MI cutoff, just throw this 360. That's the only one you have to have in there. Calculate MI on balance, this is for government loans. So it should automatically check once you use that drop-down menu and you choose that it's an FHA. And finally, adding my hazard insurance, collecting 2 plus 12 months, so a total of 14. And right now we are collecting 9 months for tax reserves in Southern California. You'll add in yours. Now I'm going to add another product. Now remember, this is where it becomes fast because now I'm going to start using this product that I built first in order to build any of my other products. Any questions up to this point? You can raise your hand if you do have a question. I can also unmute you if you don't want to type it in. We'll probably spend the most of our time on this going through the output and how to leverage that output. So product 2, I prefer using the 5% conventional. You might like using the 3%. It's totally up to you. It's also up to what your borrowers have. Maybe they don't have that 5%. And the 3% is by default what you have to use. Again, product template I could use, but I'm going to copy it from my FHA and click on OK. I'm going to turn off my upfront premium. I'm going to change this to 5%. If there's a change in interest rate, I'm changing that interest rate. If your fees are different based on your loan type, you could go in and quickly drop in your new fees. Leaving prepaid days of interest, everything else the same. I'm going to look up my mortgage insurance, put in what my mortgage insurance would be, take that calculate MI off, add my 78%, and most companies at this point are 120 months. So Tracy, I'll add another loan product and we'll talk about down payment assistance. That's a great one to add on to this loan. So now I have my second loan option. So let's say they are looking at Home Ready or Home Now, one of those loan options that they could add to that FHA, and they're like, what if I do that with the FHA versus the 5% conventional? So I'm going to do my FHA with, let's say, 3% Home Now. I'm going to copy it from my FHA. Everything is probably going to be the same. Down payment or interest rate might change. I'm not familiar with the product to know if they're regulating that interest rate for you or not, but that might change. And then I am going to put my down payment assistance in my closing cost fee. So if I go in here, I can add a fee. There is a fee called down payment assistance. I have a ton of fees. This is my oldest account. I'm going to say it's 3%. I like placing it broker paid. They also are going to have a, they're going to have a down payment processing fee. So I can go in here, down payment assistant processing fee, and I'm going to say that's 1%, and that's paid by the borrower, applying that to the loan. Any questions on that down payment assistance? Here is the rule of thumb with down payment assistance. If it is a down payment assistance that either is no payment until they refi or they sell or they pay it off, and it's a silent second, or if it is one that dissipates and they will not pay it after 5 years, it will be placed in here as a closing cost fee. And once it's placed in here, the broker is paying it, it's going to be applied towards the APR cost. Then it's going to go towards the lowering the down payment amounts. Once I have that in there and I apply it to the loan, it's going to take that amount off. So my client would then have less money to come in. If it is a down payment that does have a payment, even if it's an interest-only payment, you will click on, does this product have a second lien? Yes, it does. And then it will start asking about the second lien product. So the only time you would place it as a second lien is if there is an actual payment being made. If there is no payment being made, it is always dropped into your closing cost detail fee area. Any questions? Any other example you would like me to throw in there? So is there any other type of product that you use with a first-time home buyer that you're like, Tina, here's a product I need to see because this is what I'm using with my first-time buyers? All right, looks like we're good. I'm going to go into my analysis now, and I would set this up based on my client. Remember, property appreciation is every year in that long-term analysis time frame. So for every year, for 10 years, I'm going to have 4%. So make sure that you are keeping this conservative. Short-term and long-term, you want it to match your client's goals. If you don't know what your client's goals are, you can come in here and put, and I would suggest 60 and 5 or 60 and 10. 60 is because it matches till a respite. It's a great check-in point. If I'm using MI, I'm probably want to make sure I check in with my clients before that 5-year time frame. We want to either refinance them out or get it dropped off, but that is why we're going to place that long-term at 5. If they are not using MI, I like using 10. 10 is the new 7. People are selling their homes approximately every 10 years. And then now we're at a little different spot. Short-term type. Unless you are using tax benefit, always leave it on rent versus principal paid. And we'll go back and talk a little bit about tax, using that tax information, but because it's not relevant in every area, I save that for the end in case you want to jump off. So if you're not using it, always show rent versus principal paid. What am I showing? I am showing disposable money with disposable money. This is money your client will never see in both cases, the rent and the principal paid. However, principal paid is building them equity. So that is a benefit. They're not going to see it. It's going out of their pocket, but it is building equity. The long-term chart care, I prefer to show net worth. And the reason why is because it's going to zero that net worth out of the rent. It's going to show them no matter what you're doing, you're not going to be earning any money or growing your money if you are renting. It's only going to happen if you are buying. I can go in here. I can show total principal paid. Now that principal paid, it's pretty much showing the same thing as up here, just a different time frame. So I don't like doubling it up. I like to be able to give my clients a little bit more. But if you have that client that maybe is very limited mindset wise, and you feel like it might be too much to explain more, make a match. That's going to eliminate that need to explain a little extra. Or total interest in MI, again, disposable with disposable. You will never see this again, disposable. It does not build your equity. So that's going to be placed in there. Again, I like showing that net worth, so I'm going to place that in there. Clicking my next button, if I wanted to turn one off, maybe one is not going to be an option, simply unchecking it. Finally, clicking on my preview and adding my quote date and previewing the presentation. So here is where your rent versus own is different than your total cost analysis. In a total cost analysis, I am showing the total payment up here, the difference between them. So this one would have the most expensive, so then I would show the savings between these two. In the rent versus own, I am showing the net monthly payment. What is the net monthly payment? It is the true cost of your payment. So I am taking out, if you look down here, I have total payment less the principal that is building equity gives me my net monthly payment. It is the true cost of owning that home. So that is what I'm showing in this window. This is exactly how I would explain it to the client. This is the true cost of home ownership. What I'm taking is I am taking your total payment, I am subtracting money that comes back to your pocket in form of equity, that principal, and that is what I'm getting, the true cost of your payment. More information, where I would focus here, of course, would be that mortgage insurance, because that's going to come into play for those clients on that monthly payment. Closing costs, again, bulk or itemized, either one. You will see that Home Now loan down here. So I can highlight it and then click off of it, so when the client comes in there, they see it highlighted to show them they're getting that assistance money. Rent versus principal paid is what we're showing. We went over a little bit in there. It's just going to give you some balances in that 5-year period. And same with the net worth. You're welcome, Michael. Have a great day. In that net worth, I'm just showing balances in that time frame, so I can easily get it. So any questions on the rent versus own that you have? Again, you can raise your hand if you do have a question that you want me to dive in further and explain. If not, you can feel free to jump off the call, or you can stick around if you want to hear about the tax benefit, because that's the last part I'm going to go into, is the tax benefit on the rent versus own. In many markets, the tax benefit is not going to be a benefit to the client. Okay, looks like there's no questions. We're going to jump over here and we're going to go into that affordability section. Bottom of the affordability section, you are going to see tax benefit information. Now, everyone receives that standard deduction. No matter what, you're getting a standard deduction for your client. We have a cheat sheet over here for standard deductions. Yes, I will be sending this out to everyone after the call. It is being recorded. So let's start first with a single person. Single person standard deduction is 12%. I'm going to come in here and I'm going to put that $12,000 here. I'm going to say this person, how much do they make? $65,000, so they are in the 22% tax bracket percentage. And they are filing single. If, and I haven't checked to see if MCC credits are still out there. If they are, here's those MCC credits. It is the high percentage, the percentage that they qualify for, and the maximum credit amount. So now I'm going to click my next button so it pushes over into the presentation so we can talk about it in the presentation. So on that tax bracket, what you're going to see is there is a very slight tax benefit on the FHA. Now you'll also see that net monthly payment is subtracting their tax benefit as well, because that's money coming back into your client's pocket in the form of a tax refund or reducing their tax cost. So again, that is being subtracted from the total payment. So now, and I'm going to go up and clear out my highlights now to configure this net monthly payment. I am taking my total payment, less tax benefit and less principal paid to get that net monthly payment, the true cost of home ownership. The only one that has a tax benefit is these two. Those FHAs do have a tax benefit, and it's because that MI is pushing them into that tax benefit section. Now, on here, I might choose in my analysis to show rent versus tax benefit, which of course, rent is going to be much more expensive than that tax benefit is, or I can show the tax benefit analysis, which is going to show them that slight tax benefit for that FHA options. So we're gonna leave it on this one and go over here so you can see what it looks like. Give it a second. Sometimes it stops liking me because I change the graph so often. Let's just reopen it. So now we can see, again, only a slight tax benefit. Now, how do I know that it's a tax benefit? Because over here, there is a different amount. Let's move this tax benefit to someone who is a married couple. Married couple gets $24,000 no matter what. So what does that mean? That means the interest of the home alone has to be higher than $24,000 in order for them to have a tax benefit simply for buying the home. Could they have a tax benefit because it throws them into a spot where they can now do standard, or they can not rely on the standard deduction, but itemizing? Absolutely. But we are not qualified to talk to that amount. We can only talk to the interest of the home alone, but it is a great spot for you to be able to pull in tax qualified people who can talk about it. So I'm going to say at $24,000, they would still be at 22%. They are now married filing jointly. And now my presentation is going to change because now they have a higher tax benefit, but the interest on the home is not high enough for it to be a tax benefit of buying. That tax benefit of buying all matches in both of these windows. So in this case, I would not show a tax benefit to the client unless they are right there on that teeter-totter spot. Like if they were a single person and that FHA had a slight benefit, I'm going to pull in a tax advisor and I'm simply going to say, you know what? There is a very slight tax benefit on that FHA. I have a feeling you might have a tax benefit on buying with that 3%, but I'm not qualified to talk about that. Can I talk to your tax advisor or your financial advisor in order to have a more thorough conversation so you understand the impact of the taxes with you buying the home? So it's a great spot for you to leverage getting someone else on your team to pass away referrals. And let me tell you, tax season, they are your best friends because they see exactly what people are paying in interest. And if they're paying too high of interest, they can refer you. They are one of the first people that are notified when a divorce is happening. So they can then give you that information. So if you can pass over clients to them this way, they'll see the benefit of you and they'll possibly start passing over clients the other direction. Great spot to build up that relationship. Any questions? And again, you can raise your hand if you do have a question. Actually, there's not a ton of people. I'm just going to click allow to talk. So if you do want to talk, you can unmute yourself. And for some reason, Chad, it's asking me to promote you to panelists. So if you do, on a few of you, it's saying promote to panelists. So if you do want to be promoted, please just let me know and I will promote you to panelists so you can talk. Almost done. So any questions? And again, you can unmute. Looks like we are all good. I am going to have our next week one, and I'm gonna go cheat because I changed it up on the page and I didn't change it in mine. So next week is a move up buyer analysis. This is a great one to be able to show clients how to sell and buy into that next property at a similar price range. So if you haven't already signed up for that move up buyer analogy, then I will throw that link in here where you can go copy that link. We will deep dive into that one as well and how to leverage it. But since there is no questions, I will let you guys go, and I hope that you guys have a fabulous week. Bye-bye.